in the quiet suburbs of America, where manicured lawns and white picket fences once symbolized stability, a silent financial storm is gathering strength beneath the surface. Mortgage payments that felt manageable just a few years ago are now colliding with rising interest rates, shrinking real wages, and the most expensive cost of living in modern history. For millions of homeowners, the dream of security is slowly transforming into a relentless struggle to stay afloat. What once represented generational wealth is increasingly becoming a fragile liability, vulnerable to forces far beyond individual control. By 2026, those forces may reshape the American housing landscape in ways not seen since the Great Financial Crisis. Unlike the sudden collapse of 2008, this crisis is unfolding gradually, almost invisibly, across kitchen tables and monthly bank statements. Adjustable rate mortgages are resetting at higher levels, insurance premiums are surging due to climate-related risks, and property taxes are climbing as local governments scramble for revenue. At the same time, household debt has reached record highs, while savings rates continue to decline. The pressure is not explosive, but cumulative, eroding financial resilience one payment at a time. For many families, the margin for error has all but disappeared. Housing has long been the cornerstone of middle-class wealth in the United States, representing the largest asset on most household balance sheets. For decades, rising property values provided a sense of safety, allowing homeowners to borrow against their equity for education, healthcare, and retirement. Yet this dependence on housing appreciation created a dangerous illusion of stability. When prices rise faster than incomes, debt fills the gap, and households become increasingly exposed to economic shock. The very asset meant to protect families has quietly become a source of systemic vulnerability. The financial environment of the 2020s is unlike any previous period in modern history. Central banks raised interest rates at the fastest pace in decades to combat inflation, dramatically increasing the cost of borrowing. Mortgage rates that once hovered near historic lows surged above levels unseen since the early 2000s. For new buyers, affordability collapsed, while existing homeowners faced rising refinancing costs and shrinking access to credit. The housing market slowed, but household obligations did not. At the same time, inflation reshaped everyday life in subtle but devastating ways. Food, energy, healthcare, and transportation costs consumed a growing share of monthly income, leaving less room for mortgage payments and emergency saving. While official inflation numbers fluctuated, the lived experience for many families was one of constant financial strain. Wages failed to keep pace with rising expenses, particularly for workers outside the highest-paying sectors. The result was a slow erosion of purchasing power that weakened household balance sheets year after year. Beneath these pressures lies a deeper structural issue within the American financial system. Homeownership is heavily dependent on long-term debt, making families sensitive to changes in interest rates and credit conditions. When money was cheap, borrowing felt safe, even necessary. But when financial conditions tightened, that same debt became a burden. The system rewards leverage during expansion, yet punishes it during contraction, trapping households in a cycle they did not design. The risk is not limited to individual homeowners, but extends to the broader economy. Housing markets influence consumer spending, construction employment, banking stability, and local government finances. When homeowners struggle, the ripple effects reach far beyond their neighborhood. Reduced spending weakens businesses, declining property values, strain municipal budgets, and financial stress spreads through the credit system. What begins as a household problem can quickly evolve into a national economic challenge. History offers sobering lessons about what happens when housing markets and debt collide with economic shock. In previous cycles, rising interest rates and falling affordability triggered waves of defaults, foreclosures, and forced sales. While the conditions today differ in important ways, the underlying vulnerability remains. High leverage, limited savings, and rising costs create a fragile environment where even modest disruptions can have severe consequences. The question is not whether pressure exists, but how much the system can withstand. As 2026 approaches, the financial resilience of homeowners will be tested by forces that extend beyond any single policy decision or market fluctuation. The convergence of debt, inflation, interest rates, and economic uncertainty is creating a landscape where Stability is increasingly difficult to maintain. For millions of families, the home they worked so hard to secure may become the greatest source of financial risk. Understanding how this situation developed is essential to understanding what may come next. The vulnerability of homeowners in times of financial stress is not a new phenomenon, but a recurring feature of modern economic history. In the early 20th century, American families also believed that property ownership guaranteed long-term security, particularly during periods of rapid urban growth and industrial expansion. Easy credit, rising land values, and a booming economy encouraged households to borrow heavily, often with minimal savings, as a cushion. When the economic cycle turned, those same families discovered how quickly the promise of stability could collapse. Housing, once again, became the epicenter of financial distress. The Great Depression of the 1930s offers one of the clearest examples of how fragile homeownership can become when debt meets economic contraction. As unemployment surged and incomes collapsed, millions of homeowners were unable to keep up with their mortgage payments. Foreclosures spread across the country, transforming once thriving neighborhoods into landscapes of abandonment and uncertainty. By 1933, nearly half of all urban home mortgages in the United States were in default. The federal government was forced to intervene on an unprecedented scale to prevent total collapse of the housing system. Programs such as the Homeowners Loan Corporation were created to refinance distressed mortgages and stabilize communities. But the damage had already been done. Families lost not only their homes, but also their savings, social stability, and future financial prospects. The crisis reshaped the American relationship with housing, embedding the belief that government support was essential to preserving the dream of homeownership. Yet it also revealed a deeper truth. When income disappears, debt becomes unmanageable, regardless of how valuable the underlying asset may be. Decades later, the post-war housing boom reignited faith in property as a path to wealth. Suburban expansion, government-backed mortgages, and rising wages fueled an era in which homeownership became synonymous with middle-class success. For many families, rising home values were not just a sign of prosperity, but a financial strategy. Equity was extracted through refinancing, credit lines, and second mortgages to fund education, medical expenses, and consumer spending. Housing once again became both a home and a financial instrument. This model appeared stable for decades until the early 2000s exposed its hidden risks. Low interest rates and financial innovation made borrowing easier than ever, allowing households to take key on larger mortgages with minimal initial payment. Adjustable rate loans, subprime lending, and speculative buying inflated housing prices far beyond what income growth could support. By 2006, the average American home was priced at more than 5 times the median household income, a level that had historically signaled danger. When interest rates began to rise and housing prices stalled, the illusion of stability quickly unraveled. Millions of homeowners found themselves trapped in mortgages they could no longer afford, with properties worth less than the debt attached to them. Foreclosures surged, neighborhoods deteriorated, and household wealth evaporated almost overnight. The 2008 financial crisis demonstrated how deeply the housing market was intertwined with the broader financial system as mortgage-backed securities collapsed and banks teetered on the edge of failure. In the aftermath, regulatory reforms and stricter lending standards were introduced to prevent a repeat of such systemic damage. Banks required higher credit scores, larger down payments, and more documentation from borrowers. For a time, this created the impression that the housing market had become safer and more resilient, yet the fundamental structure of homeownership remained unchanged. Long-term debt, dependence on stable income, and exposure to economic cycles continued to define the experience of millions of families. What differs today is not the existence of risk, but the accumulation of pressure from multiple directions. Homeowners now face higher interest rates, rising insurance costs, climate-related property risks, and a labor market that offers less long-term security than in previous generations. The safety nets that once often financial shocks have weakened while household savings remain historically low. The system has evolved, but the vulnerabilities persist beneath the surface. History shows that housing crises do not require sudden catastrophes to unfold. Gradual shifts in economic conditions, when combined with high household debt, can quietly destabilize entire communities. The warning signs often appear long before the breaking point is reached, embedded in affordability ratios, delinquency rate, and declining financial buffers. By the time the crisis becomes visible, the damage is already widespread. Understanding these historical patterns is essential to recognizing the risks facing homeowners today. The past reveals that property ownership does not shield families from economic reality, but often amplifies their exposure to it. As financial pressures mount in the present, the lessons of earlier housing collapses offer a sobering reminder of how quickly stability can disappear when the underlying foundations begin to crack. In the years following the 2008 financial crisis, the American housing system did not fundamentally change its reliance on debt, but it did change its scale and complexity. Ultra-low interest rates introduced to stabilize the economy, reshaped borrowing behavior across the country. Mortgages became cheaper, monthly payments fell, and property values surged once again. For homeowners, the recovery appeared to confirm the long-held belief that housing always rebounds, reinforcing confidence in real estate as a safe and dependable asset. As prices climbed, so did household leverage. Home equity lines of credit, cash-out refinances, and long-term fixed mortgages became tools not only for buying homes but for sustaining lifestyles. Families used rising property values to offset stagnant wages, funding everything from renovations to medical bills. This quiet substitution of debt for income masked deeper financial fragility. On paper, household balance sheets looked stronger, but in reality they were increasingly dependent on continued asset inflation. The pandemic-era stimulus accelerated this pattern dramatically. With interest rates near zero and trillions of dollars injected into the economy, housing demand surged at unprecedented speed. Remote work expanded geographic flexibility, while limited housing supply pushed prices higher across both urban and suburban markets. In many regions, bidding wars became the norm, and buyers stretched their budgets to secure homes at historically inflated prices. The sense of urgency created a new wave of overextension. By 2022, the average American homeowner was carrying more mortgage debt than at any point in history. Although delinquency rates remained low, the underlying risk had not disappeared. Instead, it was temporarily obscured by rising wages, strong employment, and government support programs. The system appeared stable, but its stability was conditional on favorable economic conditions that could not last indefinitely. When inflation surged and central banks responded with aggressive interest rate hikes, the financial environment shifted abruptly. Mortgage rates doubled in a matter of months, making new purchases far less affordable and refinancing increasingly unattractive. Home prices began to plateau, and in some areas they declined. The wealth effect that had fueled consumer confidence weakened, leaving households more exposed to rising living costs. For homeowners with adjustable rate mortgages, the shift was especially severe. Monthly payments rose sharply as interest rates reset, consuming a larger share of household income. Even fixed-rate borrowers felt the pressure indirectly as property taxes, insurance premiums, and maintenance costs increased alongside inflation. The cost of simply owning a home began to rise faster than many families' ability to pay for it. The financial system, meanwhile, grew more sensitive to housing market shifts. Banks and investors held vast portfolios tied to real estate performance, from mortgage-backed securities to commercial property loans. While safeguards were stronger than in 2008, the concentration of risk remained significant. A prolonged housing slowdown threatened not only homeowners, but the broader credit system that depended on stable property values. Economic uncertainty further weakened household resilience. Layoffs in technology, finance, and other high-paying sectors signaled that job security was no longer guaranteed, even for skilled work ERs. Rising automation, outsourcing, and corporate restructuring created a labor market defined by volatility rather than stability. For homeowners, income uncertainty translated directly into financial vulnerability. Over time, these pressures accumulated into a fragile equilibrium. High debt, rising costs, and slowing price growth created a scenario where even small disruptions could trigger widespread stress. Homeowners were not facing a single catastrophic event, but a convergence of structural risks that mirrored earlier periods of financial instability. The system was once again approaching a critical threshold. The deeper lesson from history is not that housing markets always crash, but that they become dangerous when confidence replaces caution, when families assume that prices will always rise and incomes will always cover obligations. Risk becomes invisible. By the time the warning signs are widely recognized, the opportunity for prevention has often passed. The next shock does not need to be dramatic to be devastating. At the core of modern home ownership lies a financial mechanism built on long-term leverage, predictable income, and stable economic conditions. Mortgages stretch over decades, assuming that households will maintain consistent earnings while managing rising costs tied to taxes, insurance, and maintenance. This structure works smoothly in periods of GRO growth, but becomes fragile when inflation, job volatility, and higher interest rates disrupt those assumptions. The system does not bend easily under pressure because its design prioritizes credit expansion over resilience. Banks, insurers, and government-backed institutions form an interconnected ecosystem that depends on homeowners remaining solvent. Mortgage payments fund bond markets, property taxes support local governments, and insurance premiums protect lenders from losses. When homeowners struggle, these financial flows weaken, creating stress throughout the system. What appears to be a personal financial challenge quickly becomes a structural one, as millions of individual balance sheets connect to national economic stability. The mechanism amplifies risk because housing expenses are largely fixed, while income is increasingly variable. Unlike discretionary spending, mortgage payments cannot be easily reduced during hard times. Inflation may drive up food and energy costs, but housing obligations remain constant or even rise when wages fail to keep pace. Homeowners absorb the pressure through reduced saving, increased credit card use, or delayed maintenance. These coping strategies provide short-term relief but weaken long-term financial health. In recent years, household savings rates have fallen sharply, eroding the buffers that once protected families from unexpected shock. Emergency funds that could cover months of expenses are now rare, especially among younger homeowners who entered the market at peak prices. Many households rely on continuous employment and stable markets to meet their obligation. This dependence on uninterrupted income makes the system highly sensitive to economic downturn. Property values, which once served as a safety net, no longer offer the same security. When prices stagnate or decline, homeowners lose access to equity-based borrowing that previously helped offset rising costs. Without that financial cushion, even modest disruptions can create a severe strain. The psychological impact is just as significant as declining home values undermine confidence and reduce consumer spending. Insurance costs introduce another layer of vulnerability. Climate-related risks have driven premiums higher in many regions, especially in coastal and wildfire-prone areas. Some insurers have withdrawn from high-risk markets altogether, forcing homeowners into expensive last resort policies. These costs are rarely optional, and their growth adds to the fixed financial burden households must carry each month. Local governments, facing budget pressures, often increase property taxes to fund infrastructure and public services. While these increases may be gradual, their cumulative effect can be substantial. For homeowners, already stretched by mortgages and rising living costs, higher taxes further narrow financial margin. The burden shifts quietly but persistently onto household balance sheet. The modern housing system also depends on confidence in long-term economic growth. When consumers believe their income will rise, they are more willing to accept higher debt. When that belief weakens, caution replaces optimism. Falling confidence can slow housing markets, reduce investment, and tighten credit conditions. The system, built for expansion, struggles to adapt to contraction. Parallels to earlier financial cycles are increasingly visible. Rising leverage, declining savings, and growing cost pressures echo to conditions that preceded past housing crises. While regulatory frameworks are stronger today, they cannot eliminate the fundamental exposure created by debt-dependent homeownership. The structure itself remains sensitive to shock. By 26, the cumulative impact of these mechanisms may reach a critical point. The system does not require a dramatic collapse to cause widespread hardship. Sustained pressure applied gradually can erode stability just as effectively. For homeowners, survival will depend not only on market conditions, but on whether their financial foundations can withstand a prolonged period of uncertainty. Behind the everyday experience of homeownership lies a network of powerful institutions whose priorities are shaped by financial stability rather than household security. Central banks, commercial lenders, government agencies, and global investors all rely on housing markets to sustain economic momentum. Mortgage debt is packaged into securities, sold to pension funds, and integrated into global financial flows. For these systems to function smoothly, homeowners must continue making payments regardless of personal hardship. When inflation surged in the early 2020s, central banks responded with aggressive interest rate hikes designed to protect currency stability and control price growth. While these policies targeted macroeconomic risks, their impact on homeowners was immediate and personal. Higher borrowing costs reduced affordability, slowed refinancing, and increased monthly payments for adjustable rate borrowers. The fight against inflation shifted financial strain onto households that were already stretched thin. Banks, constrained by stricter capital requirements, became more cautious in extending credit. Home equity lines, once a common financial lifeline, became harder to access. This reduced homeowners' ability to absorb unexpected expenses or income disruption. The credit system, designed to expand during growth, tightened during uncertainty, amplifying stress rather than relieving it. Institutional investors also reshaped housing dynamic. Large investment firms increased their presence in residential real estate, particularly in high-demand markets. Their purchasing power drove up prices, making homes less affordable for individual buyers. For existing homeowners, this created paper wealth, but not necessarily financial security. Rising values were accompanied by rising taxes, insurance costs, and maintenance expenses, limiting the practical benefits of appreciation. Government policy, while aimed at stability, often reinforced existing vulnerabilities. Housing subsidies, mortgage guarantees, and tax incentives encouraged continued reliance on debt-based ownership. These measures supported prices but did little to reduce household exposure to economic shocks. Stability was maintained through financial engineering rather than structural resilience. At the same time, labor markets became more volatile. The growth of contract work, automation, and corporate restructuring reduced long-term job security. Income stability, a critical pillar of homeownership, weakened across many sectors. Even high-skilled professionals faced layoffs and industry shifts, increasing the risk of sudden financial disruption. The concentration of wealth further intensified these pressures. As asset prices rose, wealth became increasingly tied to financial markets rather than wages. Homeowners without substantial investment as outside their property became more vulnerable to housing market fluctuation. The gap between asset-rich elites and debt-dependent households widened, reshaping the social and economic landscape. Financial markets, driven by short-term performance metrics, responded quickly to signs of economic slowdown. Tighter credit conditions, cautious lending, and risk aversion spread through the system. These shifts, while rational from an institutional perspective, reduced the margin of safety for households. The system protected itself by transferring pressure downward. Acceleration is a defining feature of modern financial cycles. Information travels faster, markets react more quickly, and policy shifts occur with greater speed. This compression of time means that financial stress can escalate rapidly. Homeowners may find themselves facing severe challenges before they fully understand the forces at work. As these dynamics converge, the burden on homeowners intensifies. The system, optimized for efficiency and growth, offers limited protection during contraction. By 2026, the combined influence of monetary policy, institutional priorities, and economic volatility may leave many families struggling to maintain stability in an environment that no longer favors long-term security. The coming years may not bring a single dramatic collapse, but rather a prolonged period of financial train that quietly reshapes the meaning of homeownership. Rising costs, unstable incomes, and tightening credit will test households in ways that are less visible than past crises, yet no less consequential. For many families, the challenge will not be losing their homes overnight, but slowly losing the financial security those homes were meant to provide. The pressure will accumulate through missed savings goals, growing debt balances, and shrinking emergency reserve. In this environment, the traditional promise of homeownership as a pathway to stability becomes increasingly fragile. A house remains a place to live, but its role as a financial anchor weakens when economic conditions turn unfavorable. Property values can fluctuate, expenses can rise, and income can disappear with little warning. What was once considered a safe investment begins to resemble a long-term financial commitment with uncertain return. The psychological impact of this shift is significant. Homeowners who believed they had secured their future may find themselves confronting unexpected vulnerability. Financial stress affects not only household budgets, but also mental health, family dynamics, and community stability. The quiet erosion of confidence can be just as damaging as visible economic hardship. For policymakers and financial institutions, the challenge lies in balancing systemic stability with the household resilience. Measures that protect markets do not always protect families. Interest rate policies, credit standards, and fiscal decisions shape the environment in which homeowners operate, yet their consequences are often felt unevenly. The burden of adjustment frequently falls on those with the least financial flexibility. Looking ahead, the survival of homeowners will depend on more than market conditions alone. Financial literacy, savings discipline, and risk awareness will become increasingly important. Households that rely solely on rising property values for security may find themselves exposed, while those who build diversified financial foundations will be better positioned to adapt. Communities, too, will play a role in shaping outcome. Local support networks, housing assistance programs, and responsible development policies can soften the impact of economic stress. While these measures cannot eliminate systemic risk, they can provide critical buffers for families navigating uncertain times. The broader lesson of economic history is that financial systems evolve, but human vulnerability remains constant. Each generation confronts new forms of risk shaped by technology, policy, and global forces. Homeownership, once a symbol of permanence, now reflects the dynamic nature of modern economies. By 2026, the question may not be whether homeowners face hard hit, but how prepared they are to manage it. The next financial shock does not need to mirror the past to leave a lasting mark. Its impact will be measured in resilience, adaptation, and the ability of families to navigate an increasingly complex financial landscape. The future of homeownership will likely be defined by realism rather than optimism. Stability will come not from assuming perpetual growth, but from understanding risk and planning for uncertainty. In a world where financial conditions change quickly, survival will depend on flexibility, foresight, and the recognition that even the most familiar institutions can no longer be taken for granted.